Welcome to our deep dive on pre-professional savings and the big question, should you risk your future tuition for potentially higher returns? In this video, we will weigh safety against opportunity cost for timelines under 3 years. We will build an action plan, highlight tax-efficient vehicles, and outline where a small, calculated risk might fit. To begin, let's preview what we'll cover and set expectations for a cautious yet effective strategy.
Next, we will walk through the agenda so you know exactly what's coming.
Here is our roadmap. First, we frame the dilemma and the golden rule. Then, we explore safe vehicles and the specific tax edge of Treasuries. After that, we consider a segmented approach that introduces a small, optional equity sleeve. Next, we cover 529 plans and why they can still help even with short timelines, followed by the long-game power of a Roth IRA. Then, we consolidate everything into a practical 30-day action plan, examine a quick instrument comparison, and test your understanding with short quizzes. Finally, we'll summarize key takeaways and close with important disclaimers. Now, let's set up the dilemma you're facing. You've done the hard work, accumulating tens of thousands for a near-term education goal. However, as high-yield savings account rates soften, it's natural to wonder if you should reach for more return. The catch is that your time horizon is short, so the risk of loss right before you need the funds is significant. Therefore, this trade-off, safety versus opportunity cost, is the crux of the decision. With that in mind, let's articulate the golden rule that guides money needed in under 5 years. The core rule for money needed within 5 years is principal preservation. When your timeline is short, the sequence of returns risk matters far more than incremental yield. That means your core allocation should prioritize liquidity, low volatility, and predictability, typically through high-yield savings accounts, certificates of deposit, treasury bills, short-term treasury ETFs such as SGOV, and high-quality money market funds. In other words, this is not the time to stretch for return at the expense of capital safety. Now that we've established the rule, let's examine each of the safe vehicles and where they fit. High-yield savings accounts offer daily liquidity and deposit insurance within regulatory limits, though rates can change. Certificates of deposit can provide rate certainty, but early withdrawal penalties reduce flexibility. A CD ladder can help balance access and yield. Treasury bills and short-term treasury ETFs are backed by the U.S. government and typically provide state and local tax exemption on interest, which can lift your effective yield depending on your tax situation. Money market funds are convenient and liquid, but you should check their underlying holdings, risk profiles, and expense ratios. With the components laid out, let's compare the tax and liquidity dynamics of Treasuries versus HYSAs. Treasuries tend to have an edge in after-tax yield for investors in higher state and local tax jurisdictions because Treasury interest is typically exempt from those taxes. They are backed by the U.S. government, and you can access them directly through Treasury auctions or via short-term Treasury ETFs like SGOV, though ETFs introduce small market price fluctuations. High-yield savings accounts, by contrast, offer straightforward daily liquidity and deposit insurance within limits, but the rate is variable and can fall without notice. If you prize guaranteed daily access and simplicity, a HYSA may fit best. If after-tax yield optimization matters and minor price variability is acceptable, Treasuries can be compelling. With that context, let's visualize the tax flow specific to Treasuries. When you earn interest from U.S. Treasuries, you generally owe federal income tax but not state and local income taxes. This state and local exemption can enhance your net yield relative to fully taxable bank accounts, especially in higher tax states. Many Treasury ETFs pass through this exemption, but it's important to verify in the fund's tax documents. With taxes in mind, let's discuss how to segment your savings to balance safety with a minimal, optional growth sleeve. A pragmatic approach for short timelines is to secure the majority, typically 70 to 90%, in ultra-safe instruments. Then, if you have the tolerance and capacity for risk, you may earmark a small sleeve, up to 10%, for a broad, low-cost index fund to hedge inflation and capture potential upside. Importantly, this is controversial because equities can decline at the worst possible time, so any equity sleeve should be small, fully optional, and aligned with your risk tolerance. Having laid out this barbell concept, let's test your understanding with a quick question before we move on to education-specific accounts. Question: for money you will need in under 5 years, what is the primary guiding rule? The options are: 1. Chase the highest yield available. 2. Maximize tax deferral at all costs. 3. principal preservation with high liquidity. Or 4. Concentrate in one aggressive growth fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is principal preservation with high liquidity. When your time horizon is short, the magnitude and timing of potential losses outweigh the benefits of marginally higher yields, so capital protection and access are paramount. Now let's move into a powerful education-specific tool that can boost after-tax results even on a short timeline: the 529 plan.
A 529 plan can still make sense even if you will need the funds relatively soon.
The key attraction is tax-free growth and tax-free qualified withdrawals.
Many plans include stable value funds or extremely conservative target date options that keep volatility low while preserving the 529's tax advantages. If state tax deductions or credits are available for contributions, that can further improve the math. Next, let's zoom out and make sure your long-term retirement engine is also running. The Roth IRA. If you have earned income, the Roth IRA is a cornerstone for long-term, tax-free growth. It should remain distinct from your education savings because retirement compounding benefits are hard to replace once lost. Contribution limits and eligibility can change, so verify current rules before funding. While contributions may be accessible under certain conditions, the preferred strategy is to let them compound uninterrupted. With both near-term education and long-term retirement buckets defined, let's convert this into a concrete 30-day action plan.
Start by mapping your tuition due dates and interim cash flow needs. Ensure you maintain an emergency buffer to avoid tapping tuition funds. Next, place 70 to 90% of your savings into ultra-safe vehicles aligned with your liquidity and tax profile. If suitable for your risk tolerance, create a small index fund sleeve, with the understanding that it can experience losses at an inopportune time. Open a 529 plan, choose a conservative option, and verify whether your state offers tax benefits. Automate contributions and systematize reminders to stay on track. Monitor after-tax yields relative to inflation and revisit your allocations quarterly. With the plan in hand, a quick side-by-side guide can further ground your decisions.
This table provides a quick reference. HYSAs offer daily access and very low risk with fully taxable interest. Short-term CDs lock a rate for a defined term with potential early withdrawal penalties. Treasury bills and short-term Treasury ETFs like SGOV can improve after-tax yield through state and local tax exemption while maintaining low duration risk, though ETF prices can fluctuate slightly. Money market funds provide liquidity and generally track short-term rates, but underlying holdings and expenses vary. Within a 529, stable value or conservative target date options offer low volatility and tax advantages for qualified expenses. Finally, a broad index fund may serve as a small, optional sleeve for potential growth, acknowledging market risk. Now, let's visualize how funds flow from your savings to your chosen vehicles. The diagram should begin with a single savings pool representing $30,000 to $60,000 earmarked for tuition within 3 years. From that starting point, it should branch into a core allocation of 70 to 90% directed toward ultra-safe vehicles, HYSAs, CDs, and T-bills, with an annotation that Treasury interest is typically exempt from state and local taxes. A separate, optional branch should allocate up to 10% to a broad, low-cost index fund to seek limited growth. A small cash buffer node should be represented for immediate timing needs. All branches should ultimately converge on the tuition payment due at the deadline, highlighting that liquidity and principal preservation govern the structure. With the flow in mind, let's test your understanding of 529 benefits before wrapping up. Question: what is a key advantage of using a 529 plan for near-term education costs? Your options are: 1. Tax-free growth for qualified education expenses. 2. FDIC insurance up to $500,000. 3. A guaranteed 8% annual return. Or 4. The ability to use funds for any expense without penalties. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is tax-free growth for qualified education expenses. While some states provide additional deductions or credits for contributions, the central benefit is that qualified withdrawals are not taxed. There is no guaranteed return, and funds used for non-qualified expenses may incur taxes and penalties. Now, let's consolidate the main lessons before we close with a formal disclaimer. These are the key points to remember. Near-term money should emphasize principal preservation and high liquidity. The core allocation belongs in ultra-safe instruments, with Treasuries potentially offering a state and local tax advantage. Any equity sleeve should be small and optional, recognizing the risk of drawdowns near your tuition deadline. A 529 plan can provide tax-free growth for qualified expenses using conservative allocations, while a Roth IRA remains dedicated to long-term retirement growth. Automation and periodic reviews will help maintain discipline.
Next, let's summarize the entire approach succinctly.
In summary, start by clarifying your deadline and required amount. Build your core with safe, liquid vehicles, HYSAs, CDs, and Treasuries, to preserve principal. Use a 529 plan to boost tax efficiency for qualified education expenses, and only consider a small equity sleeve if you can tolerate potential drawdowns. Keep your Roth IRA distinct to protect long-term retirement growth.
Finally, automate contributions and monitor after-tax yields relative to your goals. Before we close, please review the following disclaimer to contextualize today's guidance. Please note that this content is strictly educational and does not constitute financial, tax, or legal advice. Market conditions, yields, tax laws, and account rules can and do change. You should verify product details, prospectuses, and current regulations, and consider consulting a fiduciary financial advisor or tax professional for recommendations tailored to your needs. With that covered, let's wrap up with a quick thank you and a call to action. Thank you for watching. If this video helped you clarify your approach to safeguarding tuition while staying tax smart, please like the video, share it with someone who is preparing for professional school, and subscribe for more practical guides. In the comments, share how you plan to structure your core safe allocation and whether you will use a small equity sleeve. Your insights can help others make informed decisions.